Did you ever feel so bad inside?
Hello everyone, welcome to Random Budget Show. So for today's show, we're gonna talk about audit risk, materiality, and sampling. For the first part, let's go to Mr. Clyde.
Hello everybody. So, I will explain about concept, audit risk and materiality. So, first things first, what is audit risk? So, audit risk is anything from misstatement, fraud or error that can ruin an auditor's work in obtaining reasonable assurance in conducting audit of financial statements. By obtaining sufficient evidence and able to reduce audit risk to an acceptably low level, reasonable assurance can be achieved. Next, I will talk about types of risk in context of audit. So guys, there are three types of risk in audit. First, inherent risk, control risk, and then detection risk. So first thing first, what is inherent risk? Inherent risk is a risk that causes misstatement in financial statement that exists within an organization. Auditors can detect this risk by his or her professional judgment and years of experience in doing audit. Next, control risk refers to risk that relates to failure of client's internal control system to detect misstatement or errors and lead to uncorrected misstatement in the financial statement. Next, detection risk refers to misstatement that will remain undetected by auditors even after there are substantive procedures that has been carried out. Next, what is materiality in context of audit? So, materiality in context of audit refers to any misstatement, including omission of data, made by accountants or auditors that can affect the decision making of a business or surroundings such as circumstances in the accounting period or third parties, or that can affect individuals as a group, which refers to users. Next, how to determine materiality. So to determine materiality, it requires professional judgment by auditors, and usually percentage are used in determining benchmark for materiality. For example, 5% of profit before tax or 1% of total revenue. Factors that are considered in constructing benchmark for materiality includes the nature of a business, the elements in the financial statement, certain items in the financial statement that may highly affect a specific user, entity's ownership structure, and the relative volatility of the benchmark. Next, I will talk about performance materiality. So, performance materiality refers to an audit plan to reduce misstatement or undetected, uncorrected amount to an acceptably low level. This is to avoid from financial statement to be materially misstated. By using professional judgment and understanding of the entity, rather than mechanical calculation.
Okay, thank you, Mr. Clyde. For next session, let's go to Mr. Anwar.
In an audit engagement, the auditor should determine the materiality of clients in terms of quantitative and qualitative factor. Just now we have learned about materiality, which is the amount of misstatement that could be material to the client of financial statement, and audit risk, where an auditor gives an inappropriate opinion when the financial statements are materially misstated. Now we shall look into the relationship of materiality and audit risk. Materiality has an inverse relationship with audit risk. For example, the higher the materiality, the lower the audit risk. Let me further explain through the diagram. We can see two different beakers, and the beakers are the company. The first company is a company with low inherent risk and control risk. The symbol of the X are the material misstatements. While the company on the right is a company with high inherent risk and high control risk, which contains many material misstatements. The middle icon shows the materiality level that can be set by the auditors. For a company with low inherent risk and control risk, the auditor would set the materiality at a high level. As you can see, the auditors will be able to detect material misstatements on the above side. However, there are still a few material misstatements that cannot be detected by the auditors. Now we look at a company with high inherent risk and control risk. If the materiality is set at a high level, it can only detect a few material misstatements. However, there are still many undetected material misstatements below. Therefore, a company with high audit risk should be set with low materiality level. If the materiality level is set at a very low level, therefore, the auditor will be managed to detect more material statements above. Now that we can see the relationships between materiality and the audit risk. For a company with low inherent risk and control risk, the auditor will have to set a high materiality level. For a company with high inherent risk and control risk, the auditor will have to set it at a low materiality. For detection risk, it is a direct relationship with the materiality. The higher the materiality, therefore a higher detection risk. For a low materiality, there will be low detection risk. Now let's discuss the quantitative level and basis that can be used for valuing materiality. In an audit strategy, auditors shall determine the materiality for the financial statements as a whole. Therefore, bases are needed for valuing materiality. However, there are no official guidelines on the quantitative basis of materiality. The auditors can use the financial statements of the client to assess the value of the materiality, such as the amount of the turnover, the profit before tax, the total assets, and the equity of the company. An auditor may choose that misstatement of 50,000 ringgit or more would be material, or materiality can also be expressed in terms of percentage on the basis from the financial statements. Let me give an example. For a company with 500,000 to 1 million, they will charge a 10% base of materiality with 2.5% of turnover and total assets of materiality or a materiality limit range of 15,000 to 25,000 ringgit.
Okay, thank you, Mr. Anwar. So next we will go to Mr. Setiatu. Thank you, Mr. Setiawan. So now we will talk about factors influencing determination of materiality. When establishing the overall audit strategy, the auditor should determine materiality for the financial statement as a whole. So before this, Mr. Anwar have talked about the quantitative materiality. Now I will talk about the qualitative. So the first factors that influencing determination of materiality is the laws, regulation and other authority. Legislators and regulators are the primary user of financial statements for public sector entity. Therefore, the materiality of public sector entity are influenced by the law and regulation for the place. Secondly is misstatements. Some misstatements may affect the materiality even though the amount are very small. For example, amount involving fraud affect a trend in earning, bad outcome arise from contractual obligations and the need to follow a disclosure requirement. For the last one is professional judgment. There are no specific rules and standard in determining materiality. So, an auditor need to put their professional judgment in order to set the benchmark for the materiality level. Next, I will talk about the application of audit risk model to audit work. So, audit risk model is used by the auditors to manage the overall risk of an audit engagement. The detection risk will form a residual risk after taking into consideration of inherent and control risk related to the audit engagement and the overall audit risk that the auditor willing to accept. If inherent and control risk is high, detection risk will be put in a lower level in order to keep the audit risk in an acceptable level. If inherent and control risk is low, detection risk is allowed to be set in high level. As you can see here, this is the formula of audit risk, which is inherent risk times control risk times detection risk. From the above formula, we can find the detection risk by audit risk subtract with inherent risk times control risk. The detection risk has direct relationship with audit risk while has an inverse relationship with inherent risk and control risk. Thank you, Mr. Setiatu. So now let's go to Mr. Harman.
Hello guys, so it is my turn to let you know about the consideration of analytical review procedures. Firstly, what is analytical procedures? Analytical procedures can be defined as an analysis of significant ratios and trends and identify any unusual transaction or events which can indicate matters for audit implication. As according to the International Standards of Auditing 520, an auditor should apply analytical procedures at the planning stage of audit. This is to obtain more detailed understanding to identify the areas of risk. So, this is the natures of analytical procedures. Basically, analytical procedures is where the comparisons is made of the entity's financial information with information for a previous periods and anticipated results such as budgets and forecast and industry's average and identify unexpected fluctuations and unusual relationships. It is also includes other elements from financial statements such as gross profit or net profit, and also the financial information and non-financial information such as the relationship between payroll cost and number of employees. An analytical procedures is important for an audit planning. It should be applied in the planning stage to assist auditor understands the business and identify the areas of potential risk. Apart from that, it is also helping the auditors to determine the nature, timing, and extent other audit procedures after understanding the business. Lastly, it can also be used in analyzing both financial and non-financial information. As an example, to analyze the relationship between the increasing amount of rental expenses tend to make the staff increase, thus the payroll will also increase. So, the last topic that I will present to you is sampling. What is the definition of sampling? Sampling involves application of audit procedures to less than 100% of items within an account balance or class of transaction such that all sampling units have an equal chance of selection. As according to the International Standards of Auditing 500, an auditor should obtain sufficient audit evidence to draw conclusions on which to base the audit opinion. Hence, the auditor does not need to examine all information available but only by obtaining sampling. So, let me introduce to you the categories of sampling. Basically, there are two types of sampling, which are statistical sampling and non-statistical sampling. A statistical sampling, which is also known as a probabilistic sampling, is any approach to obtain a sample by random selection method. It is used probability theory to evaluate the results. It can rely to a smaller sample for an intensive checking and make representative to a large population, and also has a defined measure on court. While for non-statistical sampling, it is any approach to obtain sample other than the approach relies for statistical sampling, such as non-random selection method, the selection that being made by the examiner professional judgment rather than the theory of probability. The samples being chosen if the examiner believes that it will be useful, and it need more subjectivity in making decisions for the sample. So, there are three types of statistical sampling. The first one is an attributes sampling. It estimates the proportion of a population that possesses a specified attributes and characteristics. For an example, auditor wanted to test the amount of sales which lack of credit approval. Thus, the population will be all the sales and the sampling unit will be each of the sales orders, while the attributes to be tested of the sample is the sales order with a credit approval. Next is the monetary unit sampling. The method to access the amount of monetary misstatement which exists in the account balance. For an example, when auditing accounts receivable, assuming that the auditor has achieved a materiality level of 50,000, they will come up with a conclusion where any misstatement more than that amount considered material. And the last statistical sampling is classical variable sampling. It is being used to determine whether a class of transactions or account balance have misstatement or not. For an example, the auditor are doing a test count when auditing the inventory in which a significant audit differences is expected. Lastly, I will present to you the steps for the application of sampling on audit tests. Basically, there were 4 steps for the application of sampling on the audit test. The first one is planning or designing the sample. The second steps is selecting the sample. Then we test the sample obtained, and lastly, we evaluate the results.
So I think that's enough for today. So goodbye everyone and thanks for watching Random Budget Show.